This conference will now be recorded.
Hello, everyone. My name is Paolo Agostinelli, and this is the January 11th, 2022 meeting of the Pittsburgh REIA Commercial Real Estate Group. We've had some technical difficulties, but I appreciate Sal and Richie and for bearing with us. This call will be recorded, so I will make this content available to the entire group. I'll also put together organize a Facebook Live later this week, Thursday or Friday, to answer any questions that anyone has as part of the roundtable discussion. In case someone had any questions or needed any referrals or any deals to be analyzed, we can certainly still do that. But tonight our guest speaker is Sal Acosta. Sal's a business broker, and I'll let him introduce himself and his background. But what led me to seek out someone like Sal, and Sal specifically, was that over the last couple years, and even before COVID, and especially during COVID, I was talking to several commercial real estate owners who were looking to either sell their real estate and or sell their business. So some combination or whatever the reasons were, they wanted to sell their business, they wanted to sell their real estate along with the business, or so on and so forth. And the one thing I realized was that I was not able to give the commercial real estate owner a comprehensive solution in order to help them with what they needed, which was they needed someone who had expertise in selling a business. So after doing a lot of research myself, asking around, Sal's name came up a couple of times, and Sal has a lot of great content out there in terms of discussions and education materials and even interviews he's done. And after literally watching several of them, Sal, I realized that Sal had a lot of the type of values of someone that I felt comfortable working with. So that is why I reached out to him to talk to him about some of that in terms of being able to be a referral source for me to refer people to Sal. Again, so I can provide a comprehensive solution to someone who needed help with something, or needed help selling a business, or even buying a business. So I was very appreciative of that, and we've been on many calls together over the last few months, and I'm thrilled that Sal and I are looking to find ways to work together, and I'm very appreciative of Sal being able to join us tonight to talk to the subject of how to buy and sell a business. One of the things that I'm, as the facilitator and leader of this commercial real estate group, is trying to accomplish is I'm trying to expose the group, and we did some of this last year with some of our topics. But I'm constantly trying to expose the group to different investment opportunities, whether it's last year we talked about a lot of different asset classes that we haven't talked about before. But with this group specifically, there's three different types of people really that are, for the most part, that are part of this group. You have investors, you have small business owners, actively owning small businesses, and you have commercial real estate owners. So I think it's very, so I think it's this is very. There's a lot of synergy here in terms of being able to talk about how to buy and sell business. If you're a business owner, being able to prepare your company to sell, and what are the steps of that? Or even if you're an investor and you want to, an aspiring small business owner, which a lot of us feel strongly about, how to do that. And then also as an investor, how do you leverage your investment dollars into, what are those other opportunities out there? Um, so with that said, I'm going to introduce everyone to Sal and let him introduce himself and get into our conversation tonight. So Sal, thank you again for being here. Thank you for being patient with the technical difficulties. I've been fighting it all day, but this is I've been looking forward to our discussion tonight for a few weeks now. So thank you again for being here, and I'll turn it over to you.
Well, perfect, Paul. Thank you very much for that wonderful introduction. Let me share my screen real quick for a couple of PowerPoint slides. Um, okay. Okay, very good. Can you all see my screen?
I can.
All right, perfect. Actually, here, let me do something. All right, perfect. Well, thank you again for the opportunity to present to your group. Couple of things that I want to talk about is just basically an introduction to Landon and Acosta, my firm, and myself. Just a couple of slides on that. A little bit about the benefits of using a business broker, because of course, a lot of people try to do it yourself, and that's fine. But I think it's important for them to understand um, what a business broker can bring to the table and what some of the benefits of using a broker are. Then I'll go through the main steps in the buy sell process and also talk a little bit about what buyers and sellers are looking for and how, if you're thinking of selling your business, maybe some of the things you need to think about to make it as valuable and as easy to sell when the time comes. And then at the end, if we still have a couple minutes left, I can talk about, some current market trends, what we're seeing out there, and so on and so forth. Um, and Paul, by the way, and Richard, feel free to interrupt at any point and ask any questions because otherwise this will turn into a long, just sort of speech, and I'd rather have more of the interaction. So again, please feel free to interrupt at any time. So just a quick little introduction about me. I was actually born in Cuba, grew up in Puerto Rico. Spanish is my native language. Been here in Pittsburgh now for the last 10 years. It's sort of my adopted hometown. Went to school at MIT, did my engineering degree. Don't mind saying that was back in 80 to 84 before personal computers were really available. And then I went straight to Tulane University. I did my MBA back in 85, 86. After that, I've always had sort of a dual career focus. On the one hand, I was involved with small businesses and entrepreneurship. On the other hand, I was fortunate enough to have some pretty high level roles for global multinational corporations. I'm not going to go into the detail, but it's names that would be recognizable to anybody. And if you're more curious, you can look at my LinkedIn profile. Um, just to talk a little bit now about the types of clients we can help in terms of business size. We're focused on what's called Main Street businesses and lower middle market. So those are any companies that on the low side may have as few as 10 employees. On the high side may have all the way up to 250. From a revenue perspective, anywhere from zero all the way up to about 10 or $20 million in revenue for the year. And from what's called EBITDA or net cash flow perspective, hopefully break even in spite of everything that's going on with the coronavirus and everything else right now, to about $1 million or $2 million, and again, net positive cash flow for the year. So does that all of that make sense up to there, Paul and Richard?
Yep, with you so far.
All right, excellent. So let me just switch gears here for a second, talk a little bit about the benefits of using a business broker. Because again, clearly there's the option of trying to do it yourself. So one is, of course, a broker will bring their expertise and their experience to the table. Basically what is the process, which is some of what we're going to cover today, but obviously in a lot more detail. Because this is not their first rodeo. They know how to find buyers. They know how to find sellers. They have a feel for what can be negotiated and also what is reasonable or typical. And frankly, that to me is one of the most important things because let's be honest, business owners are typically very involved with their business emotionally. They may have started it 10 or 20 or 30 years ago from scratch. This is their baby. And so sometimes they're not as objective or as unbiased as they should be when it comes time to selling the business, valuing the business, doing the negotiation for selling the business. And a good business broker can bring that objective pair of eyes to the transaction. And again, some experience as to what is reasonable, what is not reasonable, because they've gone through multiple transactions. Whereas the business owner, unless he's a serial entrepreneur, is basically doing this once in his lifetime. Beyond that, of course, their network, and it's kind of like what Paul alluded to a little bit ago in the introduction, right? The broker will know bankers and lawyers and accountants and realtors and insurance agencies and agents and so on and so forth. And by the way, when we're talking about these small business transactions, it's important to get professionals that are focused on that specifically. Not every CPA is familiar or even interested in supporting this type of small business transaction. Not every lawyer has a practice that is focused on buying and selling small businesses. So it's important that you get the right professionals that have, again, that practice and that experience in those areas. And lastly, let me talk a little bit about the confidentiality of the process. One important thing that the broker brings to the table is he can keep the fact that the business is up for sale confidential. And that is extremely, extremely important. You don't want the customers, the employees, the suppliers knowing that the business is put up for sale. In the case of the customers, they could seek a new service provider because they don't know what's going to happen in the future, if the new owner is going to raise prices, change the product offerings, whatever the case may be, move the business. The employees, kind of same thing. They could get anxious or nervous and say, oh my God, what if I get laid off? What if the new owner brings in his own crew or his brother or his friends or just doesn't like me? The old saying that the best time to find a job is when you have a job. So they may decide that they want to leave on their own terms and jump the gun a little bit. And suppliers, same thing. They could, get nervous and eliminate credit or incentives because they may not know who the new owner is going to be or their reputation or their credit score, credit worthiness, whatever the case may be. So they may start to tighten down again in some of the incentives and credit and other things.
Sal, I have a
So
question. I have a question
sure.
about that, if I could. So, in terms of that confidentiality being important during the process of a small business looking to sell to a new owner, obviously those, and I can guess at how to manage this, but I'm going to ask you. But how does that get managed? How is that different than whenever all these suppliers and customers do realize that there is going to be a new owner? Are they more aligned with wanting to or willing to go along with? I guess there's less certainty because you know what the new terms are going to be, you know who the owners are going to be. But how do you manage? How does someone who's buying a business manage all those points? I mean, it's very similar to residential housing. I'll use a simple example where if a tenant knows that they're going to have a new landlord, they might be concerned about rents going up. But how do all those points, whether it's suppliers or other partnerships or clients, how do you, as someone who may be buying a business who has to deal with those issues when they're close to, if not actually purchasing the business, those issues don't go away. But what about that makes it more tolerable, I guess, for suppliers or customers? Is it just a certainty that they just know who's going to be there and who they're going to be working with and who they're going to be working, who the new owners are? Is that certainty? Is that enough to not have customers jump ship? Um,
Okay, so nothing is written in stone, and it's a little bit of a mutual back and forth dance of both of the parties developing kind of trust in each other and
mhm,
recognizing that they're both serious about doing this deal. But just to give you maybe some guideposts, for lack of a better term, the absolute first part of the process is that, and I have it right there on the slide, is that potential buyer sign what's called an NDA. That stands for a non-disclosure agreement, which basically says exactly that. Hey, we're going to give some information to the buyer, and you're not supposed to share it with anybody else. Okay. Um, and by the way, even with it after the NDA is signed, you may not necessarily immediately reveal all your information. You know, some of the documents that you provide, even after an NDA, may be redacted, which basically means you black out some information that you don't want to disclose at a relatively still early stage in the process. So, you know, if you provide a list of vendors, for example, or customers, you know, just to show sales or purchases or whatever, you may redact the actual name and address and phone number of those customers or those vendors. Obviously, later on in the process, you know, those redacted documents become unredacted, and then everything should tie out, right?
mhm.
Um, but to maybe go down the road a little bit, and we'll get to this here in a couple of slides. But there's a point in the process where the buyer will submit what's called a letter of intent, which is now it's getting more serious. I'm jumping ahead, but to answer your question, I view that almost as a dry run or a dress rehearsal for the transaction. You start talking about specific prices and specific terms, even though it's not, you know, all of that is non-binding. And then after that happens, and again, understanding that it's non-binding, but usually the transaction is a little bit more serious. So at that point, you can start introducing the buyer to the landlord, for example, if that's the case, because a lot of times that lease will need to be assigned. So, I mean, that will just have to happen at some point in the process. Also, by the way, which is again, is a very tricky situation, the buyer will want to meet usually with some key employees. So again, at that point, you know, you may have to trust in those key employees to let them know that you're selling the business and then introduce them to this potential buyer that has now given to you a letter of intent. And a lot of these things are happening during a phase of the transaction called due diligence. Um, but again, by that point, everybody's pretty serious. There might even be at least a preliminary agreement on price and terms, assuming everything checks out and there's no surprises. Um, so did I answer your question?
Oh, you did. You did.
Okay. And again, we'll talk about that in a little bit more in a couple of slides. But so anyway, as we were just talking about, the potential buyer sign an NDA, a non-disclosure agreement, which again says that you're going to give them information, and they're not allowed to disclose it to other parties that are not involved with the transaction. And also, by the way, potential buyers are pre-qualified. That's another thing that the broker does. Um, if the buyer, well, you know, it doesn't make sense to engage in a protracted negotiation with a potential buyer to have them fall in love with the business and want to do the transaction, but then simply not have the capacity to execute it because they don't have the financial resources. So there's a process for pre-qualifying these buyers so that the seller, again, has some confidence and some assurance that if the process goes all the way through and the buyer does want to buy the business, that he'll have the financial means to be able to do that.
And,
Um,
and Sal, with regards to financing a business, I mean, what are some of the most common ways of that you've seen that buyers have used to finance? And is it are we looking at SBA loans? Are we looking at partnerships between investors and operators? How would what I guess what's the most common scenarios? I mean, I know there's yeah, that's probably that's the one thing I'm curious about because I know a lot of our members are, you know, they may have cash to invest, they want to invest in business, or for whatever reason an operator is not able to, they just want to operate the business, they don't want to take out an SBA loan or can't for whatever reason. So I guess when it comes to financing, what are some of the most common ways? Like how would you rank, you know, going out getting an SBA loan or some combination of owner financing or partnerships formed between operators and investors to purchase a business. Can you just speak to, you know, how would you rank the frequency of any of those and others possibly other financing techniques used to buy a small business?
Well, and also, by the way, I think you hit the major ones, by the way, but also not only the frequency, but a little bit of the pros and cons, right?
Hmm.
So certainly a very common one, because that's exactly the point of the loan, is the SBA loan, just like you said, from the Small Business Administration. That's exactly the point of the loan, is just to help the buyer um, buy a business. And you know, sometimes you can buy the business with 10, 20% down, good credit score, and the SBA will kick in the other 80 or 90%. And by the way, just let me make a clarification, which is important on that. Technically, the loan is made by the bank, and then the SBA backs up the bank.
Right.
And the reason I make that clarification is because people need to be aware that even though technically the SBA says, like, hey, make the loan as if the SBA guarantee didn't exist, the reality is different banks will make different loans at different times.
Sure.
So just because you get rejected by one bank for an SBA guaranteed loan doesn't mean that you're not going to get accepted by a different bank for that loan. And sometimes, quite frankly, for reasons that are not even related to you, it's just, you know, their exposure, their portfolio. It's a lot of things that are maybe on their side and not even your side. But bottom line is, again, if you get rejected by one bank, don't get discouraged. Try a couple of others.
Sure.
Certainly another alternative is seller financing, where again the buyer kicks in a certain amount of money, and the rest is basically a loan from the seller.
Hmm.
The nice thing about that scenario is, depending on how motivated the seller is, he may be willing to take a little bit more risk than a bank that will ask for certain credit scores or things like that. And also the SBA requires obviously a lot of paperwork. Whereas a lot of times, if you're doing seller financing with the owner of the business, that's a less paperwork that needs to go back and forth. Then, of course, like you said, you know, if there's investors that are willing to back up that buyer, that's certainly another way to do it. And frankly, I don't want to disregard the way of, you know, the buyer may just have the money, pure and
Hmm.
simple, from whatever reason. They sold another business, or they inherited, or whatever. And maybe the last thing I'll throw out, because this is something that a lot of people don't know, and it's a little bit tricky, but it can be done.
Hmm.
Things like 401ks can be used without tax
Yeah.
penalty to buy a business. Um, and that is very powerful, especially we have a situation where maybe and I'll talk a little bit about this later too, but we have a mid-career professional that got right-sized by their big company. I love that term. Uh, but they have a very healthy 401k. They can, if they structure it correctly, can use that money again without tax penalty to buy the business. And again,
Hmm.
everything has pros and cons. The cons on this one is very obvious. If if the business doesn't work, if you don't know how to run it, or something happens, you've risked your retirement funds, and the purchase of this business, right? But if the SBA doesn't want to land, or the bank with the SBA, whatever, you don't have investors, the seller doesn't want to do it, that's one more alternative that you have out there. So I think with that, we've covered at least the most typical ways of financing a transaction, and hopefully a little bit of the pros and cons.
And Sal, I just wanted, if I could, just very quickly go back to the to what you were talking about with regards to owner financing. So, I mean, anytime you're talking, anytime you're trying to negotiate a deal, you're trying to understand what motivates either a business owner is looking to sell their business, or a property owner looking to sell their property. So, what types of scenarios do you find that owners, small business owners, are more willing, or more open to owner finance? Is it a function of maybe a business that's just hard to sell for whatever reason because there isn't a large buyer pool? Is it because they're asking their asking price is maybe a little bit high, and or is it a function of they don't know what to do with their investment once they cash out, and they figure, well, I'll make at least some return by seller financing a portion of the sale. Again, are there certain, what is that a function of when small business owners are willing to consider seller financing? Like, well, in your experience, what scenarios mostly exist in order for them to consider that? So for example, I would take your answer and say, okay, if I'm talking to a small business owner who's looking to sell their business, okay, well, is it because they're like in a very niche industry or something that makes it difficult to sell, or some other aspect that makes it difficult to sell? I'm just curious what most, not most, because I know this is very granular, but uh, what are some of the most common, characteristics of a business or owner that um, that would maybe, as a buyer, say, hey, you know what, they might consider this because it's a business in this industry, or or they're asking a lot for the property, and maybe they'll finance it if they're asking maybe a premium price, or what is that a function of? A seller's willingness to offer owner financing, at least partially, on a purchase.
Yeah, so you're absolutely right. And initially, most sellers do not want to do seller financing, and the reasons are the obvious reasons, right? They're scared they're not going to get paid. They're scared that the buyer is not going to run the business correctly, and again drive it into the ground, and then there won't be again an ability for them to get paid. So I think, then to like, and you really hit almost all the nails on the head. Then you say, okay, fine. So the seller's scared that he's not going to get paid, and that the buyer's not going to know how to run the business. What are some of the things that would motivate them to do seller financing, right?
Mm-hmm.
And I think the number one issue is exactly that. They've had difficulty selling the business, maybe getting the price they've been asking for, or they're in a hurry to sell the business for whatever reason. Let's say they know they have a health condition that will in the near future prevent them from running the business, continuing to run the business. So they have a certain time frame that they're looking to get this transaction done. Those are all things that will motivate a seller to do seller financing. And then of course the other one is, or one of the other ones is, how is that relationship and that rapport established between the buyer and the seller as part of the transaction, and how capable is that buyer of running the business, and does the seller agree that the buyer at least has the right background, the right qualifications to run the business correctly. Maybe the only other one that I'll point out, or one other one that I'll point out, is a lot of times it's easier to get seller financing done where the transaction includes a high percentage of hard assets. Okay, and by that I mean real estate, machinery, inventory, things like that, because a lot of times that is collateral for the payments to the seller, and a lot of times if that buyer does not make those payments to the seller, then the seller takes over the business again. And even if the business maybe has been harmed by the buyer not running it correctly, or losing customers or whatever, at least the hard assets, again, the real estate, the machinery, the inventory is all there, and will be there protected, maybe through some contracts or covenants or whatever. So at least the seller is assured that there's some assets that they'll get back when they get the business back, in the case that the buyer doesn't make the payments as scheduled. And to your point, certainly from the seller's perspective, that is one reason to ask for a little bit higher of a price than you would otherwise. Is the fact that you're willing to offer this seller financing. So I think I basically covered a lot of the same things you said, and I'll stop there, and I hopefully I answered your question.
Absolutely. Those are all great points. Absolutely. Thank you.
Okay. I'm going to move real quick into the main steps for selling a business. And again, the process meanders. I don't want to give the impression that this is written in stone, but this is certainly a very typical process and a very typical flow that will cover a lot of transactions. And I'll go into all of these in detail, but just to maybe give a summary before we start, the main steps for selling a business is, first we have to prepare. Then typically we have to value the business. We improve the valuation, and I'll talk about why that is there. We establish the process drivers and key players. We identify, find, and qualify the potential buyers. We enter into a process of negotiation and hopefully reaching an agreement. We get to the letter of intent, as I mentioned a while back. And then we do a thing called due diligence, and hopefully all the numbers check out, and then we can proceed to closing. So that's kind of the 30,000 foot view, and I'm going to talk a little bit about each of those steps. Matter of fact, any questions with those steps before I dive into talking about what each one is? Does that flow make sense or align with what you would have thought?
It does. It does.
Yes.
Okay, perfect. So the first step is prepare. And again, considering that we're dealing here with small businesses, a lot of times just prepare, some people even call it like a reverse due diligence, but basically it's a lot of paperwork. It's gathering all the information, all the paperwork, all the reports, all the financial statements, all the tax returns, and I have checklists of everything that needs to be put together. But basically it's gather all the paperwork so that you are ready to engage with the buyer when the buyer comes along. Because the rule of thumb is, once you engage with a buyer, you can speed up the process, but you should never slow it down. Because if you slow it down, now you're running the risk that the buyer changes his mind, gets a better deal somewhere else, just whatever, gets tired. So you want to have all your ducks aligned so that when you engage with that buyer, you maintain the pace at a minimum or speed it up. And also this prepare step is very important, because if you find gaps or missing documents or outdated documents, it gives you the opportunity to find those documents, prepare those documents, get those reports, and again, get everything in order before you have a buyer at the table. I can't tell you how many times I've run in this situation, again, especially with the smaller businesses, where they don't have a copy of their lease. Maybe their lease was signed 10 years ago and it said that after a while it goes month to month and they've been paying and the landlord's been collecting the check and everybody's happy and they don't have a copy of the lease. Well, that's one of the first things that a potential buyer is going to ask for. Same thing with financial statements, tax returns, things like that. A very rough rule of thumb is you should have financial statements, income statement, balance sheet, tax returns for at least the last 3 years. Obviously, the more information you can have ready, the more prepared you're going to look to that buyer and the better the impression you're going to make. This is a game of reducing the risk for the buyer. The more information that you can provide at the appropriate time, the less risk that buyer is going to perceive and the more willing he's going to be to pay the asking price or a higher price because you've reduced his risk and his uncertainty. So anyway, that's the prepare step. It's getting all the documents into a data room at a minimum into something like a Dropbox or something to be able to share them, expeditiously with a potential buyer that's serious. A lot of people ask me how long it takes to sell a business. And you can see here that on the bottom is the size of the transaction. And you can see that as the transactions get bigger, maybe as you would expect, it starts to take a little bit longer. And we're looking at anywhere between 6 months to almost 12 months. At the end, it actually starts to drop a little bit and become a little bit faster. And I think the reason for that is when you start getting into these bigger transactions, everybody at the table, whether it's the business brokers on both sides, the lawyers, the CPAs, sometimes even the buyers and the owners, they've been through this process before. So they know what needs to happen. They know what each side needs to do. They know the documents that need to go back and forth. So long story short, they can move through the process a little bit faster. But in any event, 6 to 12 months is a good range to plan for. And frankly, it surprises a lot of people how long it takes to do this. So now you know. Okay, before I go to the next step, does that prepare step make sense?
It does. It does.
Yeah.
And Sal, just to give you a heads up, the slide we're seeing is still the title the title page. I'm not sure if you were referencing other slides, but Richie, I don't know if you're seeing it on your end as well. But I still have the front the cover sheet is the in the sharing screen here.
I'm on slide 115 out of 150, value of the business.
Oh, wow. Okay. I'm not seeing that. So I hope, okay. Gosh, I'm having all kinds of problems tonight, guys. I apologize.
Well, on my screen, I'm exactly the same thing, 115 out of 150. Okay. But don't worry, I did not go through 115. A lot of those were hidden slides that did not display.
No, I know.
You didn't miss 114 slides.
No, I understood. Okay, good. It's
all right.
Just gray cloud hovering over me tonight. We're good.
All right. So the next step in the process is called value the business, and it's now that you have all the documents collected, prepared. There's no gaps. There's no missing document. Everything is up to date. You're in the correct position to go and value the business. So you know what a good asking price would be. There's a lot of ways to value a business, a lot of models, a lot of methods. I'm not going to go into that because we could be here for another 115 slides. But the one thing I will mention is CPAs will typically do this. There's a designation called CVA, Certified Valuation Analyst. They can do that too. A lot of brokers will provide opinions of value. So there's different resources that you can use. But basically, after you've gathered all your documents and you've prepared, you're in a good spot to go and value the business. and at least come up with a good idea or a range for an asking price. Another slide that I'm showing.
Sal, I had a question for you about that, and like I said, I'm not sure if you're going to address this in the slide or not. A lot of valuation techniques, and I fully recognize that. But for example, if from and I don't like to rely on rules of thumb, but for example, if you're looking at 25, if you had a spreadsheet of 25 of just high level numbers of maybe 20 different businesses, and you're skimming over the numbers, what are some valuation rules of thumbs? Is it just purely as an initial screening? Are you looking at multiple per sales, multiple per income, and even still, how do you? I know there's not a lot of value in the long term in that, but just when you're initially, I have a conversation with someone and they tell you, oh, my gross is X, and I made Y last year, and right away, what's that range in my head that I should? I know it's a function of what I want my return to be, but what does the market say that valuation should be based on either gross revenue or even and/or net income? Are there high level rules of thumb? Just like I said, you still have to do the due diligence and dig in and validate those numbers and whatever models. I mean, you want to invest in something, obviously it's going to give you a return that you want and need, but what does the market dictate? Those valuation ranges are based on either sales or income. Again, just purely as an initial, and I hate rules of thumb sometimes, but just to see like where that dart is on the board, like how close is that, or is it way off? Or maybe you look at something and say, wait a minute, that's a really low price. I would have expected it to be selling it much higher based on the income, based on and that's what makes you dig into the numbers more. So any rules of thumb in terms of valuation of multipliers or anything like that you would tell folks to consider or not consider, or how much weight to put in on those?
Yeah, well, no, that's actually the funny enough, the slide that I'm showing right now.
Okay, I'm sorry.
Yeah, no. So let me say this is again, there's multiple ways to value a business. I mean, you can do it based on revenue, you can do it based on profit, you can do it based on cash flow, you can do it based on net assets, all sorts of rules, all sorts of things. And sometimes, by the way, when you get a formal valuation report done, they'll use, all sorts of different methods, sometimes even comparing to public companies or databases or whatever, and come up with multiple methods and maybe throw out a couple and average the rest. Frankly, I am very old school and maybe a little bit hard nosed about it. I start from the perspective that certainly for small businesses, okay, we're not talking, you're going to be Facebook and take over the world and have these tremendous networking, network effects or, synergies or whatever. The purpose of a small business is to put cash in the owner's pocket. I think most people would agree that's why they buy a business, is to basically generate cash to put in their pocket. So if that's the case, then I say, well, okay, let's value based on that ability of the business to put cash in your pocket. A lot of times that gets transformed into an EBITDA, earnings before interest, taxes, depreciation, amortization, maybe for the bigger companies and the bigger transactions. Business brokers tend to use this term SDE a lot, seller's discretionary earnings, which is basically the cash that's being put in your pocket, adjusted for how that business is going to be run most efficiently, most productively by the new owner in the future, okay? And there's this process of what's called add backs. Frankly, sometimes owners have expenses in there to lower their tax payments that the new owner is not going to have, or at least shouldn't value based on that, right? The the fancy car, the golf course membership, things like that. Sometimes employees that are family members or whatnot, that really don't contribute to the business and should not be there. So you add all that back. And then you come up with, again, seller's discretionary earnings, which is that cash flow adjusted for these expenses that don't belong. Right. And then you can't see my chart, but just to kind of walk you through it, basically, as the transaction gets bigger, those multiples go up because, of course, bigger transactions are bigger companies, which tend to be a little bit more developed, a little bit more robust, a little bit more diversified. Basically, long story short, representing a lower risk profile. But just to give you some multiples, on the low end, you could be looking at a 2 multiple on seller's discretionary earnings, sometimes even down to 1.5. Okay, now once you're in the multi-million-dollar transactions, you could be looking at multiples in the range of 3.3, 3.5, even up to 4.5 and 5. And again, these are, the numbers on this slide are averages. So that by definition means that even within each one of these vertical bars, you're going to have some people below that number and some people above that number. But again, to give you some rules of thumbs, for the smaller transactions, you're in the 2.0 range, and then in the bigger transactions, you're above 3. Okay. And one of the things we can talk about as we go on into this presentation is also what types of characteristics are buyers looking for to then put you within each one of those bars, above average or below average, or towards the top end or towards the lower end of the spectrum, because again, these are all averages. Okay, so did I answer your question, and does that make sense?
It does. Thank you.
Okay, usually there's a step called improving the valuation. And frankly, it's because these multiples surprise business owners as to how low they are. Okay. Sometimes they're listening to the TV, they're looking at the multiples for publicly traded companies. And for publicly traded companies, it's not unusual to have a PE ratio somewhere in the neighborhood of 12, 15, 20, 25. If you're something like a Tesla, you're off to the races, right? But again, these companies are a completely different risk profile from a Facebook or a Google or anybody in the S&P 500. So it surprises people how low the owners that want to sell the company, how low these multiples are. So usually we have to enter into a process of improving that valuation. And again, we could be here all day on this particular step, but let me just say this: a lot of times business owners have created what's called the lifestyle business, which is basically just for them to have sort of some income, a salary substitute. They're running the business very comfortably. They haven't grown it. They haven't invested in human infrastructure, and they don't have a real standalone business that can then be transferred over to somebody else without a lot of the value walking out the door with the current owner. And so in this process of improving the valuation, we want to correct all that so that we have a business that a lot of the value can transfer to the new owner, and as little bit as possible walks out the door with the old owner. Okay, and again, we can talk a lot more about that, but that's just a general concept. Mm-hmm. Then after that, we have to establish the process driver and the key players. Obviously, I am going to say that the process driver should be the business broker. And some of the key players are, you should have, at a minimum, you should have a lawyer involved in your transaction. You should have a CPA or an accountant involved in your transaction. Usually there's going to be a banker involved in the transaction, maybe from the buy side. The one person that should definitely not be the process driver is the business owner. And the reason for that is, at this critical juncture in the process, what the business owner should be focused on is running the business correctly to maximize profits, to maximize sales, to make sure there's no hiccups, to make sure there's no surprises. Because if you allow the performance of the business to just slip a little bit, you're going to give a great excuse to the buyer to try to lower the valuation. So the owner needs to be 100% focused on the performance of the business, making sure it's hitting on all cylinders, that nothing slips. And because this is a lot of work and a lot of time and a lot of effort. So let your business broker handle that. The business owner can support him. He's going to have a team. He's going to have some lawyers. He's going to have some accountants to help him. But make sure you establish who the process driver are and who the key players in that team are. Okay. After that, obviously, we go to the process of finding potential buyers, identifying them, and qualifying them. That's where, again, the the business broker takes the lead on that, and he has certain databases and certain processes to do that. And then after that, after we go into a process of negotiation and hopefully reach some type of agreement. Again, we could be here all day talking about different negotiation strategies. There's entire books on that, and reaching agreement. The important thing, and again, this is an optional step. It doesn't have to be this way. Sometimes you can go straight to the asset purchase agreement. I personally like to do an intermediate process called the letter of intent, which again, to me, is a dry run or a dress rehearsal for the asset purchase agreement. You put the major terms in there. You put at least an initial agreement on price in there, so that there's no surprises down the road. Sometimes, if it's a big deal, people like to do even a more preliminary step, maybe like an indication of interest, where the buyer says, hey, based on what you've told me, I think your business is worth this much. And sometimes it's even a range. Hey, I think your business is worth from here to here. And then later on, drive to the letter of intent. But the important thing here, by the way, is, and I can't stress this enough, the letter of intent is non-binding, usually. So that means that later on down the road, both the buyer and the seller can back out for any reason or no reason at all. But at least there's been an initial effort to have a meeting of the mind, again, in terms of the major terms, and in terms of the price and timing and so on and so forth. Okay, questions up to there? No?
No, I think that was a pretty good description of the process.
Perfect. All right.
Sorry.
Well,
I'm sorry. I had myself muted. The quick question for you regarding the LOI and other due diligence steps. What part of the process is it appropriate to submit deposit monies? Are they optional? Are they refundable, non-refundable? When do monies go hard? That sort of thing. I know part of that's part of the negotiation, but what's typical? What's I don't want to say what's standard, but I hate that question. I hate that comment. But what's reasonable in terms of at what point in the step are you actually putting money down to either tie up the opportunity And is that money go hard? Is that option, or is that option consideration, or at some point is that refundable if you don't complete the purchase?
So those are all great questions and great points. And I will tell you, frankly, a lot of it comes down to negotiation. And I'll try to give you maybe the perspective from both sides. Okay. But if there was to be a deposit, it would usually happen at this stage with the letter of intent. You would get that deposit. Um, Obviously from the seller side, you want that deposit to be as big as possible, because the bigger you can get that deposit, the more uh interested and the more committed and the more solid your buyer is, right? From the buyer's perspective, obviously you're going to want that deposit to be as small as possible, or nothing at all. And the argument you're going to make is, recognize that I'm going to devote a lot of cost to due diligence, which is the next step coming up. It's not unusual, depending on the size of this transaction, for the due diligence to run into thousands of dollars for the buyer, because now you're bringing on board your lawyers, your CPAs, and I'm jumping ahead a little bit, but you're going to bring in your group of professionals to go over everything with a fine-tooth comb, and they're going to charge you for that, whether the deal goes through or not. So the buyer's going to be spending thousands of dollars to conduct this due diligence, and the argument they're going to make is, hey, I'm serious and I'm committed, because look at me, I'm going to spend these thousands of dollars to make sure that everything you're telling me is true, right? From the seller's perspective, and then again, part of the negotiation is there an exclusivity period? Okay, a lot of times when these letters of intent happen, the buyer doesn't want the rug pulled out from under them. So they'll ask for an exclusivity period where the seller and the seller's brokers commit to not trying to sell the business or engage with anybody else, to basically deal with them only and exclusively while they conduct their due diligence. Because again, what the buyer wants to avoid is that they're spending thousands of dollars on this due diligence that could take, for example, 90 days. And on day 89, because the letter of intent is non-binding, the seller comes in and says, hey, you know what? I got a better offer from somebody else. We closed the deal. Sorry. See you later. And again, these numbers are all over the map, but I do want to maybe give you a feel. 10% would not be an unreasonable number to ask as a deposit, a down payment, whatever you want to call it, with the letter of intent. You typically put it in the escrow, so it's not in the hands of either party. And then again, is it refundable or not? That's a big negotiation, but usually the trade-off goes, I'm going to give you exclusivity, recognize that I'm losing the opportunity to continue to market this business while I work with you. And in exchange for that, I want you to make the deposit non-refundable, unless, and then maybe you put some things in there about, hey, is there fraud? Is there misrepresentation? Is there stuff that I told you that it's just completely wrong? Things like that. And that's where the lawyers make their money, is crafting all that text, right?
Yeah.
So
that's all reasonable. That's all reasonable. That certainly makes sense.
Yeah. Okay. Richard, makes sense to you as a CPA?
Yes, it does.
Okay. All right. Well, then we go into the famous due diligence phase, which is basically, again, up to this point, the seller has shared information, both verbally and in writing, financial statements, leases, contracts, other information. maybe in. So, and the due diligence is the buyer's going to bring in, again, their team, their lawyers, their CPAs, other people, sometimes depending on the transaction, maybe environmental inspectors. I mean, it's who the right team is depends a little bit on the transaction, but certainly typical, very typical is a lawyer, a CPA, again, sometimes environmental people. And basically, this is the buyer's opportunity to make sure that everything that the seller told them checks out, everything reconciles, everything balances, all the money's going into the bank, all the expenses are getting paid, and there's no surprises, that they understand all the contracts. And by the way, when I'm involved in the due diligence process, I like to take even a little bit of a broader view than that, and not only make sure everything reconciles, everything ties out, everything, there's no fraud, whatever. I like to also think about, what is the future of this business? How am I going to grow it when I'm the new owner? Is there some synergy or some leverage with my existing operations? How am I going to integrate it into my existing operations? So I like to take a very broad view of due diligence, not simply, again, crossing off the checklist on an item, and there's checklists for this. I mean, there's the CPAs and the lawyers, they all have their checklist of all the documents they want to see, and all the paperwork that they want to have to make sure everything is in order. And then if everything checks out and there's no surprises, or if there's anything that needs to be corrected or whatever, but hopefully there's no showstoppers, and we can move to the closing, which is, for smaller transactions, it's usually in the form of an asset purchase agreement. And then that's it. The funds are transferred, the ownership is transferred, and there may be a training period after that. And there may be other things like earnouts and things like that. I won't go into that right now. But that's pretty much it. And then the only other thing I'll say is, just for the record, I wrote a book, Secrets to Buying or Selling a Business. So it's obviously a lot more detail than what I'm able to go into this presentation. But you can get it on Amazon, and there should be my contact information. So Richard, I'm assuming that you're with me. You're seeing this, my contact information there in the slide.
Yes, I can see it slide perfectly.
Okay. Well, I know we talked about maybe talking about some trends, and I don't mind. I've got some slides on that, but we've been here for 57 minutes. So I don't know if you guys have any final questions or final thoughts or anything else you want to talk about.
I personally do not. I mean, if you have time and Paul has time and we want to go over the trends, I certainly have time for it. But if you want to wrap up, I understand that as well.
Yeah, I don't know if there's a couple bullet points that stand out among anything else. I do realize we have been on for just almost a solid hour. So if there's a couple quick things that are certainly head and shoulders above anything else, I think any considerations or trends, even if they're just general trends to pay attention to, there's so many different inputs to what's going on in small business and regulation and things in the economy. They're just one or two things that stand out above all else, that we should be considering. This is probably another hour conversation. Uh, but
Well, I will just mention a couple of topics, and I'll just mention them as such. But one topic is, coronavirus is still going on. And although the data seems to indicate that Omicron does not lead to as many hospitalizations and deaths, it's certainly a lot more contagious. And frankly, it's just even an issue of what's going to happen in the future, and not even from a coronavirus perspective, any other virus perspective, any other pandemic, any other thing. I think people have come to realize the level of uncertainty and the level of problems that we could have in the future that are things that people had not even thought about before. You know, I'll even say it this way. If before the coronavirus, if a couple months before the coronavirus, you had told me, hey, Sal, there's going to be this virus and people are going to be stuck at home for months and everybody's going to be working from home and nobody's going to be going to school, I would have said, you know what, you're watching the Sci-Fi Channel too much. And yet there we were. So I think people have come to realize the wild things that could happen that could impact big business and small businesses and restaurant closings and things like that. So that's one issue. The other issue is, and again, this one to me is still in very much flux. You know, what's going to happen with taxes? What's going to happen with, you know, is the Build Back Better dead or not dead, or even any other significant spending programs? And then again, where's the money coming from? And you know, is this going to be supported by taxes? And if it is it, you know, estate? Is it capital gains? Is it a tax on wealth, on assets, on this and that and the other thing? And by the way, I take a broad view on that in the sense that even if that happens after you've bought a business and maybe you're not subject to those higher capital gains, as an example, the guy that's buying is going to want to sell at some point because he's not going to own that business forever and ever. And so now if he's thinking, okay, I just bought this, when it's my turn to sell, I'm going to have to pay a much higher tax and I'm going to get much less from my retirement plan. That may start to impact his valuation and his thoughts about buying the business and what this business could be worth, right? And then just to throw out maybe one last topic, just because it's in the news so much, is this whole issue of interest rates and inflation, right? I mean, you know, everybody's getting pressured with inflation. It's a question of, can you pass it on to your customers or not? Interest rates are going to, you know, going back to the buying of the business and the financing, you know, as the Fed fund rates goes up, the prime rate goes up, interest rates go up, loans are going to become more expensive. And going back to the topic of valuation, one way to value a business, or at least a sanity check on a valuation of a business, is to say, okay, is this business going to give me enough cash to make a nice income substitute for me if I had maybe a prior job as a professional or whatever? Those are going to be my living expenses. Is it going to give me a nice salary? Plus, is it going to give me the ability to pay back the loan, interest and principal? Plus, is it going to give me a little bit of a safety margin and all that? And to the extent that interest rate starts to go up and those loans get more expensive, you may have to lower the price of the business to get all that to work out. Okay. So just some thoughts.
Yeah. No, those are all very good points. I just had one last question for you, if I could, Sal. Whether it was your past experience working for some of the blue chip companies that you worked for, or even now as a business broker, where we talk about all these, you know, we try to predict the future, right? Everyone's trying to put together a 5 or 10 year plan, and most of those are only as good as those as their assumptions, and a lot of those assumptions are difficult to make. I mean, we've talked in this group, like as part of early year or even end of the year strategic planning sessions. You know, looking at different frameworks of looking at scenario planning for certain things, or this might seem academic, but using putting together a Porter's five forces analysis on certain things. I know that sounds academic, but a lot of times we read news and we say, okay, coronavirus is spiking, everything's bad. As opposed to looking at the details of, okay, what specifically, depending on what you're looking at, whether it's a business, maybe some of these things there's a lot of tugs and pulls. And so it's hard to like read one article and make like a summary expectation as to what's going to happen. Just curious, and this might, I don't know if this is going to resonate with some of the folks who've been in our past commercial group meetings where we have talked about strategic planning models and is there any that you formally have used as part of your business? I realize this is probably a reach question, but are there any scenario planning or anything else that any formal either decision-making tools or strategic planning tools that you feel have worked for you when we're trying to digest all this information?
Porter's five forces is certainly a very good analysis to do. And again, that would fit in very nice into the due diligence phase, again, as I envision it in its broadest possible context. Another thing that I like to do is what's called a SWOT analysis, right? Strengths, weaknesses, opportunities, and threats. Again, that gives you sort of a nice view into, what the business could be and what it is you're buying. And the other sort of thing that I like to do and that every buyer should do, even sometimes the seller will kind of give you this prepackaged, and that's fine, nothing wrong with that. But I always encourage the buyers, and certainly when I'm representing them on their side, to do their own financial forecast. Again, for 5 years or as far into the future as you think your crystal ball can be accurate, and not to your point to get too academic on this, but certainly to use that financial forecast and that model to try to identify what are some of the key financial drivers. And then do various different scenarios, moving those financial drivers around. You could even go as far as to do some type of sensitivity analysis or Monte Carlo simulation if you wanted to. Because again, one of the questions that may help you answer is, you can say, hey, listen, my forecast says that I should be able to have a cash flow of $1 million. Okay, that's fine. But as uncertainty starts to move around some of these key financial drivers, what is the probability that you'll be below break even? Okay. And to me as a buyer, I want to know not only, okay, ideally, my best forecast, most likely, whatever you want to call it, is $1 million in profit, but that's fine. Do I have $1 million in profit with a 50% chance that I'll be below break even? Or do I have $1 million in profit with a 5% chance that I'll be below break even? To me, those are different situations, right?
Great point. Great point. Absolutely. Okay, great. Well, I think that's all I had here. Richie, do you have any questions?
No, just thank you very much for all the information you presented tonight.
Yeah, absolutely. Thank you. Thank you very much, Sal. Really appreciate your time. I always enjoy talking to you. I could easily talk to you for another hour here, just out of pure enjoyment, to be honest with you. But I do appreciate your time and patience as we had some technical difficulties getting this meeting launched. But I will, again, to everyone watching this after Tuesday night, I will have Sal send me the link to this recording so everyone could view it in its entirety. Sal has his contact info and the slides. For some reason you can't access it, please reach out to me, and I would be more than happy to send you Sal's contact info. And like I said, I'll try to follow up with the Facebook Live or something to that effect over the next several days here, just to make sure everyone has an opportunity to talk about any, since we're missing out on the roundtable discussion, in case someone has any questions about deals they're working on, need a referral, or have any questions about anything that was either discussed here in this presentation or just on anything else that you're working on. So with that said, Sal, thank you very much. I really appreciate your time and going through all this great information. I really appreciate it again.
No, absolutely. Thank to both of you for allowing me to present, and it's been a pleasure. And if anybody wants to just have even an informal conversation, please feel free to reach out via email, phone, however you want to do it. And I would be delighted to talk about any particular scenario or situation that you may have. So thank you all both very much.
Okay, great. Thank you very much, Sal. Have a good night, Richie. Thank you very much again. Talk to
Yep.
you all
Have a
soon.
good night, both of you.
Take care.